CarMax is facing a crisis that almost no one saw coming, and it's shaking the used car market to its core. Cars that were selling for $40,000 just a year or two ago are now struggling to fetch $15,000, and this isn't happening quietly in the background. It's happening right on CarMax lots across the country. What once looked like the smartest bet in automotive retail is suddenly starting to look like a massive miscalculation, and the consequences are brutal. During the pandemic, CarMax went all in. Used car prices were exploding, supply was tight, and demand felt endless. CarMax paid top dollar at auctions, overpaid for trade-ins, and stocked up on inventory at record high prices. At the time, it made sense because cars were selling fast and margins looked strong, but the market didn't stay hot, and when prices started falling, CarMax was left holding some of the most expensive used cars in the industry. Now here's where things get ugly. As interest rates climbed, monthly car payments became painful, buyers pulled back, lenders tightened approvals, and suddenly those high-priced used cars stopped moving. Vehicles that CarMax bought at peak pricing are now worth far less, and every price cut hurts their balance sheet. When a $40,000 SUV gets marked down to $15,000, that loss doesn't just disappear, it hits profits directly. CarMax's business model depends on volume and confidence. They need customers walking in, trusting that prices are fair. Financing is easy, and values will hold. But when shoppers see massive price drops, it creates fear. People start asking why prices are crashing, whether today's purchase will be worth half tomorrow, and whether it's smarter to wait. That hesitation is deadly for a retailer built on constant turnover. The pressure doesn't stop with pricing. CarMax also finances a large portion of its sales, and falling car values mean higher loan risks. When a customer owes more than a car is worth, defaults become more likely, and repossessed vehicles sell for even less in a declining market. That creates a dangerous cycle where losses compound faster than anyone expected. What makes this situation even more alarming is that CarMax isn't alone. The entire used car market is cooling, but CarMax is especially exposed because of how aggressively it expanded at the top. Smaller dealers can cut inventory and wait things out, but CarMax runs massive lots, massive logistics, and massive overhead. Every day a car sits unsold is money bleeding out, and consumers are noticing. Buyers who once trusted CarMax pricing are now comparing more aggressively, hunting for bargains, and walking away if numbers don't make sense. Online listings that once looked competitive now feel overpriced compared to private sellers and desperate dealers trying to dump inventory. The power has shifted, and CarMax is no longer setting the tone, it's reacting to it. Behind the scenes, this is forcing hard decisions. Inventory write-downs, tighter buying policies, fewer cars purchased at auction, and more cautious offers to sellers are becoming the new normal. But slowing down creates another problem because CarMax's scale demands constant movement. When growth stalls, the cracks become impossible to hide. This crisis wasn't caused by one bad decision, it was caused by believing the boom would last forever. CarMax bet that high prices were the new normal, that consumers would keep paying more, and that financing would stay cheap. Instead, reality hit fast, and now the company is stuck trying to unwind years of aggressive expansion in a market that no longer supports it. And the most important part of this story is what comes next. Because if prices keep falling, CarMax may be forced to slash even deeper, accept even bigger losses, and completely rethink how it prices, buys, and sells vehicles, especially as more off-lease cars, repossessions, and trade-ins flood the market and push values down even further, creating a situation where yesterday's premium inventory becomes tomorrow's clearance stock while buyers sit back, wait, and watch as the numbers keep dropping, and the pressure on CarMax continues to build with every passing week as the used car bubble deflates in real time and exposes just how fragile the entire system really is when demand slows and confidence disappears. And that's when things start to get even more interesting, because the ripple effects don't stop at CarMax. They spread to lenders, manufacturers, and everyday car owners who suddenly realize their vehicles aren't worth what they thought, and that realization changes buying behavior overnight, especially when people who paid top dollar just months ago now see the same model listed for thousands less, which creates anger, frustration, and hesitation. And that emotional shift is something no spreadsheet can fix, and it's already starting to show in how long cars are sitting on lots and how aggressive Collectively, prices are being adjusted as the market searches for a new floor that nobody can clearly see yet. And that uncertainty is exactly what's making this moment so dangerous. Because when nobody knows where the bottom is, nobody wants to make the first move. Buyers hesitate, sellers panic, and companies like CarMax get trapped in the middle, forced to react instead of lead. Every week that passes with soft demand means more markdowns, more losses, and more pressure to move metal at almost any cost just to keep inventory flowing. What's shocking is how fast sentiment flipped. Not long ago, used cars were treated like assets, something you could buy today and sell tomorrow for the same price or more. That mindset pushed people to overpay, stretch loans, and accept insane monthly payments. Now that illusion is gone. Cars are back to being depreciating machines, and the market is reminding everyone of that reality all at once. CarMax's massive scale magnifies every mistake. When prices drop a little, the losses aren't a little. They stack up across tens of thousands of vehicles, across hundreds of locations. A few $1,000s lost per car turns into hundreds of millions on paper, and investors notice. Confidence in the stock wavers, analysts start questioning the strategy, and suddenly CarMax isn't the untouchable giant it once appeared to be. There's also a psychological shift happening on the lots. Sales staff are dealing with customers who are more informed, more skeptical, and far less emotional. People walk in with screenshots, price trackers, and comparisons from multiple platforms. They know prices are falling, and they expect deals, not explanations. That changes the entire dynamic of the sale and squeezes margins even further. At the same time, trade-in values are collapsing. Customers who were promised strong equity just months ago are now upside down, and when CarMax offers thousands less than expected, deals fall apart instantly. Fewer trade-ins mean fewer sales, and fewer sales mean inventory sites longer, feeding the same problem over and over again. The used car market is correcting, but corrections are never smooth. They overshoot, they create panic, and they expose weak spots. For CarMax, that weak spot is inventory bought at the worst possible time. Clearing it requires aggressive pricing, and aggressive pricing trains consumers to wait for even lower numbers, making the recovery slower and more painful. And while all this is happening, new pressures keep piling on. Insurance costs are rising, maintenance is more expensive, and buyers are prioritizing necessities over big purchases. A used car that once felt affordable now feels like a financial risk, especially when headlines keep reminding people that prices are still falling. This is why the next phase matters so much, because CarMax isn't just fighting a pricing problem, it's fighting a trust problem. People need to believe that today's price makes sense tomorrow, and right now, that belief is shaky. Until confidence returns, every car on the lot is a question mark, every buyer is cautious, and every decision carries more weight than it did during the boom, especially as the market continues to shift and signals keep pointing toward more volatility ahead rather than stability anytime soon. That volatility is forcing CarMax into a defensive posture, and defensive moves rarely create excitement or growth. When a company shifts from expansion to survival mode, everything changes, from how inventory is sourced to how aggressively prices are negotiated. CarMax can't chase volume the way it used to, because every additional car bought at the wrong price becomes another future loss waiting to happen. What makes this even more intense is the speed of information. Price drops are visible instantly online. A vehicle listed today and discounted next week sends a clear message to buyers that patience pays. That trains the market to slow down even further, and for a retailer built on fast turnover, that slowdown is brutal. The longer cars sit, the more desperate the pricing becomes, and the more visible the weakness looks. Financing is another pressure point that's quietly making things worse. Higher interest rates don't just raise payments, they shrink the pool of qualified buyers. Deals that would have been approved easily 2 years ago are now getting rejected, and when financing falls through, inventory stays stuck. That creates a bottleneck where even discounted cars struggle to move. CarMax also has to deal with the aftermath of long-term loans written at peak prices. As values fall, negative equity grows, and that traps consumers in cars they can't easily trade or sell. Fewer people upgrading means fewer transactions, and fewer transactions mean less momentum across the entire system. Behind the scenes, this is likely triggering serious internal reassessments. How much inventory is too much? How aggressive is too aggressive? How quickly should prices be adjusted when the market shifts? These questions matter now because the old playbook no longer works, and the cost of getting it wrong is massive. The scary part is that this downturn didn't come from a single shock. It came from a slow tightening of money, a return of supply, and a shift in consumer psychology. Those forces don't reverse overnight. Even if rates stabilize, trust and confidence take time to rebuild, and until they do, the pressure stays on. For everyday buyers watching this unfold, the message is clear. Waiting is being rewarded. Prices are slipping, deals are improving, and desperation is creeping into the market. But for CarMax, that same reality is a nightmare, because every great deal for a buyer often represents a painful loss for the seller. And this is why the situation feels so fragile right now, because if the market dips further, the losses accelerate. But if prices stabilize too slowly, inventory still bleeds value day by day, leaving CarMax walking a tightrope where every decision matters, and every week brings new data that could force yet another round of cuts as the company tries to find balance in a market that no longer behaves the way it used to and shows no clear signs of settling anytime soon. That lack of clear direction is exactly what keeps everyone on edge, because when a market loses its rhythm, even experienced players struggle to time their moves. CarMax built its reputation on predictability, transparent pricing, and steady demand, but unpredictability is now the dominant force, and it's rewriting the rules in real time. One of the biggest challenges ahead is perception. If consumers begin to associate CarMax with overpriced cars or constant markdowns, the brand takes a hit that's hard to reverse. Trust is everything in used car sales, and once buyers feel like prices are unstable or inflated, they start shopping emotionally colder, more transactional, and far less loyal. Competitors are watching closely and adapting faster. Independent dealers are cutting prices aggressively, online platforms are trimming inventory, and private sellers are undercutting everyone just to move their vehicles. That creates a brutal environment where CarMax has to defend market share while simultaneously protecting margins. Two goals that are now fighting each other. There's also a generational shift happening. Younger buyers are less attached to ownership, more flexible with alternatives, and quicker to delay purchases altogether. In a soft economy, that behavior accelerates. Every delayed decision reduces pressure on supply and pushes prices lower, feeding the same downward spiral CarMax is trying to escape. Internally, the stress shows up in subtle ways. Hiring slows, expansion plans get paused, and cost-cutting conversations start quietly before becoming unavoidable. These are the early signals that a company is bracing for a longer storm, not a short correction. The irony is that CarMax did what the market rewarded at the time. It scaled, it paid up, and it trusted the data in front of it. But markets change faster than models can adapt, and when conditions flip, size stops being an advantage and starts becoming a liability. Right now, CarMax is caught between two realities: cut prices fast and absorb massive losses, or hold firm and risk inventory stagnation. Neither option is comfortable, and both come with long-term consequences that could reshape how the company operates going forward. And as this plays out, the broader message to the entire auto industry becomes impossible to ignore, because when the biggest used car retailer in the country feels this much pressure, it signals that the correction isn't localized, it's systemic. And that means the next moves CarMax makes won't just affect its own future, they'll influence pricing behavior, consumer expectations, and dealer strategies across the entire market as everyone waits to see whether this is just a painful adjustment or the start of a much deeper reset that still hasn't fully revealed itself yet. That possibility of a deeper reset is what's quietly changing behavior behind closed doors, because once a company starts preparing for the worst, every assumption gets questioned. Growth targets that once felt conservative now look unrealistic. Inventory levels that were considered healthy suddenly feel dangerous, and decisions that used to be made quickly are now slowed by caution and second guessing. CarMax also has to think about timing, and timing is unforgiving in a falling market. Sell too slowly and values erode. Sell too fast and you lock in losses at the bottom. The challenge is that no one knows where the bottom actually is, so every move feels like a gamble rather than a strategy. Another pressure point is consumer memory. People remember paying peak prices, and they remember who sold them those cars. When they see the same model selling for tens of thousands less, frustration builds, and that resentment doesn't fade easily. It influences where they shop next and whether they recommend a brand or warn others away. At the same time, repossessions are quietly rising, rising, and those vehicles don't enter the market gently. They come back priced to move, dragging values down further and increasing competition at the lower end. For a company like CarMax, that means even entry-level inventory faces pressure, not just premium vehicles. This shift is also forcing lenders to rethink risk, which feeds back into the sales floor. Stricter terms mean fewer approvals, higher down payments, and longer conversations that end without a deal. Each failed deal adds friction, and friction slows everything down. What's happening now feels less like a temporary dip and more like a recalibration. The market is undoing years of excess in months, and that speed is what makes it painful. Companies that expanded aggressively are feeling it first, and CarMax sits right at the center of that storm. Yet there's a strange calm on the surface. Lots are full, websites are active, and operations continue, but underneath, the math is tightening. Margins shrink quietly before headlines catch up, and by the time the story becomes obvious to everyone, the damage is already done. This is why the coming months matter more than anything else, because they will reveal whether CarMax can adapt fast enough to stabilize, or whether the weight of expensive inventory and shifting demand will force even more drastic changes as the market continues to slide and expectations reset lower and lower, setting the stage for consequences that extend far beyond just one company and into the broader economy, where vehicle values, consumer debt, and financial confidence are all tightly connected in ways that are only now starting to become impossible to ignore. That connection to the broader economy is where this story gets even heavier, because cars sit at the intersection of consumer confidence, credit availability, and household debt. When car values drop fast, it doesn't just hurt retailers, it hits families who thought they were financially stable and suddenly aren't. That ripple effect feeds back into spending behavior, making people even more cautious. For CarMax, this means the fight isn't only about moving inventory, it's about surviving a shift in mindset. The era of impulse upgrades and emotional purchases is fading. Buyers are calculating again, questioning again, and walking away again. That slows the entire machine. There's also pressure coming from new vehicle pricing. Automakers are quietly adjusting incentives, offering better financing, and cutting MSRPs on certain models. When new cars start looking more reasonable, used cars lose their advantage, and that squeezes CarMax from another angle it can't control. The company is now operating in a world where every advantage it once had is being tested. Scale, selection, and convenience don't matter as much when price and timing dominate every decision. And when price becomes the main battlefield, the company holding the most expensive inventory is at the biggest disadvantage. What makes this moment so critical is that mistakes now are amplified. A bad buying decision today could take years to unwind. A misread on demand could lock capital into depreciating assets, and a slow response could permanently damage brand perception in a market that doesn't forgive easily. Employees feel it too. Uncertainty trickles down from the top. Sales goals get adjusted, pressure increases, and morale becomes harder to maintain. A tense internal environment makes it even harder to deliver the confident, seamless experience CarMax is known for. All of this builds toward a question that hasn't been answered yet. Can CarMax reset its pricing, inventory strategy, and customer trust fast enough to regain control? Or will the market keep dragging values lower until the damage becomes structural rather than temporary? And that unanswered question is exactly why this situation keeps escalating, because as long as buyers believe prices will fall further, they'll wait, and as long as they wait, pressure builds, creating a self-reinforcing loop that keeps tightening around CarMax and the entire used car industry, pushing it closer to a turning point that feels inevitable but hasn't fully arrived yet. That sense of an approaching turning point is what keeps tension high, because markets rarely move in straight lines. They lurch, they stall, and then they snap. CarMax is trying to stay balanced in the middle of that motion, but balance is hard when the ground itself keeps shifting. Another layer to this crisis is inventory age. The longer a car sits, the more it costs, not just in lost value, but in storage, reconditioning, and opportunity. Every day, unsold inventory piles up expenses that quietly eat away at margins. Multiply that across thousands of vehicles, and the impact becomes impossible to ignore. Technology, which once gave CarMax a huge edge, is now exposing weakness. Real-time pricing data shows exactly how fast values are falling, and consumers can see it too. Transparency cuts both ways. When prices drop, there's nowhere to hide, and excuses don't matter. There's also a growing gap between asking prices and what buyers feel is fair. That gap creates friction, longer negotiations, and more abandoned deals. In a hot market, that gap barely existed. Now it's wide, and closing it often requires painful concessions. CarMax is also facing competition from a source it can't fight directly: time. Time favors the buyer in a falling market. Every week that passes increases leverage for consumers and reduces it for sellers. That dynamic puts constant downward pressure on pricing decisions. The emotional side of this downturn shouldn't be underestimated. Fear spreads faster than logic. A few stories of massive price drops make people assume every car is overpriced. That perception alone can freeze demand, even if some deals are genuinely good. Meanwhile, investors are watching closely. Public companies don't get the luxury of quietly adjusting. Every earnings report becomes a referendum on strategy, and every hint of weakness gets amplified. That scrutiny adds another layer of urgency to decisions that are already complex. This is the environment CarMax is navigating right now, one where confidence is fragile, numbers are tightening, and every move sends a signal to the market. And as this pressure builds, the next phase won't be defined by what CarMax says, but by what it does. Because actions on pricing, buying, and financing will reveal whether this crisis is manageable, or whether it's the start of a longer struggle that continues to unfold as the used car market searches for stability in a landscape that no longer feels predictable or safe for anyone involved. And that final phase is where everything finally comes into focus. At some point, prices will stop falling, not because confidence magically returns, but because pain reaches a limit. Inventory clears, weak hands exit, and only the companies that adapted fast enough remain standing. For CarMax, survival won't come from waiting for the old market to return. It will come from accepting that it's gone. The companies that make it through this reset will be the ones that buy smarter, price faster, and stay flexible when conditions change. CarMax still has the scale, the data, and the brand to fight back, but the margin for error is gone. Every car bought, every price set, and every loan approved now carries consequences that ripple far beyond a single transaction. For consumers, this shift creates opportunity. Better deals, more leverage, and a return to rational pricing are already taking shape. But it also comes with a warning, because the people who bought at the top are learning a hard lesson about debt, depreciation, and timing.